Hey there, everyone. Ryan Schul here. Welcome to my channel. So, if you'll notice, the narrative is shifting a little bit over time. At the beginning, when I started this journey a little bit over a year ago, I focused mostly, almost exclusively on data science topics. Now I'm starting to branch out into other things. I kind of um, discovered pretty much everything I think that I could discover in the data science space. So I'm trying to make some pivots here and branch out into other areas, specifically finance. I'm going to focus on financial analytics for a while and see how that goes. So in the project today, the narrative will be about smart portfolio rebalancing. Okay, we're going to look at how to build a dynamic target weight and rebalance when risk or trends suggest that we have to do this rebalancing. Okay, and we're going to change or charge transaction costs to make this a realistic rebalancing scenario, and then we're going to log decisions and produce simple plots at the end of this. And I'm going to show you how to create a trade blotter too, so you can see all the details of all the trades in this whole universe right here. So we're going to import data from Yahoo Finance for all these tickers. I'm going back about 5 years, just picking an arbitrary date here. This is January 1st, 2020. Today is August 20th, 2025. So a little bit less than 5 years, but pretty close. So the interval days is going to be 1 day. This is daily, but the frequency of rebalancing and the frequency of trades, which is kind of the same thing, is going to be done monthly. Okay, so if you do it too frequently, you basically trade on noise and you actually generate a lower Sharpe ratio. We're going to do monthly rebalancing because the Sharpe ratio is actually pretty impressive at the end. So that's the setup here. We are going to look at monthly frequency. Weekly would be 52 days. We're actually going to get 252 days of trading data per year. The reason we get 252 is because this is when the market is open. Well, the number of days the market is open, you subtract out all the Saturdays and Sundays from 365 days on the calendar, and there's about 11, I believe there's 11 non-trade days. These are holidays in the United States. So Christmas, Easter is one, 4th of July, Memorial Day, Labor Day, Thanksgiving, things like this, right? January 1st. So this is actually, there's not going to be any data for this, but the request to fetch this data just skips this day. Okay, so the market's closed, but we get the very next day that the market trades. So here I have some parameters that I'm working with. There's some constraints that I'm applying. This is giving a minimum tilt of 0%. This is a maximum weight, or maximum weight. Yeah, I'll call it a weight. This isn't a tilt. The tilt comes next. Maximum weight of 60%. So we don't put too much into the portfolio into one asset, right? We want to have a diversified portfolio. If one stock is really outperforming all the others, that's fantastic. But I don't want to invest 100% of the portfolio in just one stock. Then you have concentration risk. So we guarantee diversification by setting an upper threshold. And if the stock isn't good, we're not going to allocate anything. That's the minimum threshold. The tilt strength is going to give the optimizer an extra 25% boost towards assets that have stronger recent performance. Okay, so there's recency emphasis here. The target volume is going to be 12, so this is 12% annualized target volume. We're going to try to beat that. Okay, that's what the model is going to try to outdo. The volume total is going to be around 30%. Drift per asset is about 3%. Drift sum is about 0.09. Right, so 9%, and the MOM is momentum. Regime flip is 2. We have a cooldown bar of 2, minimum trade of 2%, turnover cap of 20, smooth target alpha. Alpha is above and beyond what we can generate just from normal trading or just from trading in the S&P 500. We want positive alpha, right? Positive returns. Trade only month end. This is going to guarantee that we have month end trading. Again, that's better than daily, better than weekly. Month end seems to be the best, producing the best sort of Sharpe ratio. I'll show you that in a few minutes how that works. We have a couple more parameters down here. Total basis points is 2 and slippage is 0. Okay, so I created a few different user-defined functions over here and set some parameters for these. We're looking for Yahoo tickers that have a minimum number of observations. If there's too few observations, we're just going to skip it. But these are all Dow 30 components. Okay, so you definitely have sufficient historical data for these going back to 2020. I believe all of these will go back 5 years, right? These are big blue chip companies, so they should all go back 5 years. I'd be surprised if any of them don't. When I'm looking at the list, pretty sure they do. Just in case you pick some stocks, because you can put in whatever you want, my stock or my ticker, EKR, whatever. If that's what you want to do, that's fine. But if it doesn't have sufficient data, it's not going to cause them all to crash or fail, right? It's just going to skip those. So that's the point of that. And by the way, of course, you can change this date. You can change any of these stocks to be whatever you want, right? So it's pretty scalable, pretty flexible. You can change all these controls over here, right? So these are sort of guardrails or sort of parameters I'm defining over here. I think this makes sense in this kind of scenario, the strategy that we're exploring today, doing this portfolio rebalancing. But again, these are just parameters that you can change. So if you feel obligated to do that, by all means, go ahead and dissect that. So here's some basic parameters. Some user-defined functions that I'm setting up to go ahead and pull down the data, right? And then to get the closing price, and anything that looks kind of weird or something gets dropped off here. Okay, good, keeping it dropped, just gets dropped off here. And we are going to go ahead and forward fill any missing data. So this comes from Yahoo Finance. I wouldn't expect any missing data, but if there is some weird freaky thing where there was a bad data point or something, it just gets forward filled. Okay, so I wouldn't expect any, certainly in this list of tickers, but who knows, there could be some weird anomaly thing that pops up. And if you start picking some tickers that don't have a deep history or that somehow could have missing data points, and that's a nice feature to have, just to add that in. It's just a one-liner. I think it's nice to have that. So here's a couple more UDFs down here. These are user-defined functions. I'm going ahead and calculating the volume and then the weights. I don't really have time to get into all of these, like a deep dive into the description of all of these UDFs, but you know what? Do some Googling online if you feel compelled to use ChatGPT, right, to help you answer questions. If you have very specific questions, you can post those in the comment section, or any insights you like the work or whatever. Okay, post that in the comments. If you have any general things, you would probably get a much faster response posting that on Google or ChatGPT than in the comment section below. But maybe that's up to you. So we're calculating the momentum signal right here, the momentum tilt. Remember, that is how much more that we're going to put into high performing assets. I think I set that to 25%. If I go back and look, yeah, 25%. So there can be an extra bias towards stronger performing stocks. Okay, so we're going to pick that. We're going to pick up on that. Build target weights. So this is momentum. These are the weights for the returns, weights for the target. Okay, then we define the portfolio volume. Again, we're looking at weights and returns. So we're picking up all the weights, all the volumes, all the momentum. So we're in good shape here. Drift trigger. So now we're looking at things like differences over time. Is the difference, is it increasing? Is it decreasing? Things like that. We're trying to understand how these stock prices are moving over time. We're picking up the volume trigger. Okay, and the momentum flip trigger. Okay, so just a very basic couple of lines of logic here. If momentum previous is none, then do the flip. Otherwise, flip and take the integer of the momentum. Okay, so we have a smart rebalancer backtest. So we collected all this information, right? We have the historical time series data. We have some triggers. We have momentum, returns. What else did we get? Volume, right? So now we're going to take all of this and bake this into our calculation engine right here. Okay, so that's what this logic is doing right here. We're getting history, portfolio returns, anything held in cash, anything that gets logged. We're going to collect all these logs as a list. Okay, so there's basically four types of data types in Python. You have lists. I use lists a lot. That's what we're looking at here. Anything with square brackets. A tuple will have curly brackets. A dictionary, or dict, it's pronounced dict, will have kind of like wavy curly brackets, and then data frames, right? That's those are the four main types of objects in Python, and there might be a couple of others that aren't used that often. I'm not sure, but those are the major ones. So we go ahead and do all the calculations down here based on the momentum, based on the target raw, the target previous, okay, and we collect all of those and we want to append that into our logs. So when we get down here, this is the log list, right? So I just told you about the list. We create the list over here. Then we start to do all the appending into the list. So we're doing all the calculations, right? All the trading, should we trade, should we not trade? When do we do the trades? Which tickers are we trading on, right? And which dates are being traded? So we collect all this information and append it to the log. So we collect the date, event, right? Drift, volume, momentum, anything like that, turnover, drift, L1, maximum performance, volatility, low, high, and flips. So everything gets into the momentum. This is now preserved, and we're taking a copy of what we just created above, right? So I always like to take copies. I think that is good practice. Control V. Okay, so the momentum now, we take a copy and create a new object, which is identical copy of the original one, right? So now everything has been collected, calculated, and we could go ahead and convert this into a data frame, right? So remember I said that there's like 4 major types of objects in Python, right? The data frame is probably the most frequent, at least for myself. I use lists a lot. I use data frames most frequently, dictionaries once in a while, and tuples every once in a while. That's very, very infrequent, but I guess there's a time and a place for that. So let me go ahead and run this logic, and you can see how it works. Okay. Actually, let me stop that. I'm not sure if I captured the first part. I think so, because it's running and it's not showing me any errors. So I think it did pick up on this, but let me just make sure. So jumping the gun a little bit there. Okay, so everything is set up. We can go ahead and do the download for the data, apply all the functions, right? All the UDFs are going to run, and we're going to get our performance printouts right here. I want to look at prices, backtesting, and number of rebalances. So a rebalance is basically when the calculation engine decides to go ahead and make adjustments to the weights of those stocks in the portfolio based on the trades, which is coupled with the logic that I just showed you, right? So daily rebalancing is too frequent. It creates a lot of noise and a lower Sharpe ratio. I tested weekly. It lifted the Sharpe a little bit, but not substantially. I tested monthly, and the Sharpe went up quite a bit, and I stuck with the monthly. So the number of rebalances total is 19. That's 19 times that the weights in the portfolio are rebalanced. Again, the maximum would be 60%. The minimum would be 0% if the stock isn't performing well. And based on all that, we can go ahead and create a report too. So we have the final NAV. This is the net asset value, 2.164. So just a little more than 2 times boost in the NAV. We start at 1.0, so basically 0. So it goes up 2 times. That's 200%. Annual return on this strategy is 16%. Annual volatility is 16%. And the Sharpe is 1.0. So it's pretty decent Sharpe. Number of rebalances we saw before was 19. Total turnover was 3.8 times. And total cost is 7.6 basis points. Okay, so I think the portfolio is in pretty good shape, and I'll show you why. We got the Sharpe ratio right here. So this is the risk to return. This is the return on the portfolio minus the risk-free rate of return, right? So that would be the borrowing cost, or the cost to borrow funds. If you have to invest those funds, it's going to be pretty low, maybe close to 1%, maybe hovering around 1% these days. Might be a little bit higher actually. 1.5%, but these are pretty low. So you're looking at the returns that you generate minus the risk-free rate and divide by the standard deviation of the portfolio, and that's how you get your Sharpe. So this is a Sharpe for ARK. This is Kathy Wood's Sharpe. I'm looking at 5 years of data. So her ARK fund has 0.13. We have 1.0. So really blowing away that ARK fund right here with this strategy. So pretty happy to see that. Here, 0.15, right? We have 1.0. So I don't know how many times more that is. Six times more, approximate. And here's definition. Anything greater than 1.0 is considered good. Anything 2.0 and higher is very good. 3.0 is excellent, and under 1.0 is suboptimal, right? So That's one thing I don't understand. Like everybody's talking about how great an investor Kathy Wood is, but that Sharpe ratio is like pretty it's pretty low. Okay, so I'm not sure what's going on there, and that's it's pretty low too. So anyways, the portfolio is outperforming, right, beating expectations. So we're looking good there. So I like that graph. I'm a big fan of Plotly graphs. I'm going to go ahead and replot the whole thing using Plotly. You can see again, the NAV is 2.16, right? Over here, 2.16. So that's looking good. And if we go down here a little bit further, we can go ahead and create some logic to just show you all the details of all those trades, all the trade dates, the tickers that were traded, the price, the buys and sells, and then the overall cumulative return. Okay, so that's what this is doing. And again, I'm creating all the rows, doing the append to that list that I created above, right? So this is pretty typical in Python to create the list, do all the appends, then convert the list to a data frame. That's very common. You see that a lot. And in this list, I have date symbol, decide either buy or sell, right? Price, weighted, the weighted delta, the notional traded principal, number of shares traded, and realized P&L. When we go down here, we can see what the totals are. Ending NAV was 2.164. So this is a net asset value. That looks good to me. 2 times gain on the NAV. Total P&L is 1.16 mil. So we took some losses, right? We took some hits. Not every trade is going to be profitable. Obviously, you're going to have some losses. There's no portfolio that only generates gains. That's impossible, right? So we took 1.063 million losses, but we generated returns of 2.27 million, right? On 1 million invested. If I go over here, look at the top, 000. So we should find that right here. So capital, beginning capital was 1 million. So we converted 1 million into a profit of 1.16 million. So basically doubling, right? And the total unrealized gains, this is gains still inside the portfolio. We haven't traded out of these positions. This is realized P&L, right? So we traded all the bad stocks, got rid of those, and there's going to be some losers no matter what. This is a cumulative return that we see over time in the last column, and here's all the details here, right? So you see the portfolio started on January 1st of 2020, right? But the first trade date is 9/30 because it takes about 9 months for the strategy to build up, for the model to detect what needs to happen and to build up what the trading engine needs to do. I can't just trade day number 1. It has to see, based on some time series data, in this case it's 9 months of data, it has to see what's going on. Then it can start to make buy and sell recommendations. So this first sell is Goldman. This was the price. This is the weight, the notional, the number of shares traded. So because it's a sell, it's negative. Over here, this is the buy, so this is positive, right? So positive, positive, sell, negative, buy, positive, right? So number of shares traded, price, and then the cumulative unrealized P&L, right? So if I go down here, P&L 2.169. So again, positive, we started with $1 million, now we have 2 million, so a little bit more than double. And if I go ahead and hit this, we have a Plotly chart now that shows the NAV, the total P&L. That's what we saw before. We saw that before. We saw that before. This is just a plot of everything, right? So all the worst stocks, all the traders were basically dumped out of the portfolio, and we got rid of those losers. But you will have some losses, right? You can't have only gains. That's impossible. The total P&L, all the losses minus the gains here, and all the gains show up over here, okay? Or at least the unrealized P&L. This is what's still on the books. This is what has been sold off, okay? So basically, this is the takeaway. What does the script do? It pulls clean market data from Yahoo Finance. It computes the returns and the risk stats, right? It builds a baseline target weight. That's why it takes 9 months. I told you that before. So the first trade comes in, I think it was September 30, 2020. You have to build up the baseline target weights and build up your strategy over time, right? You can't just start trading day number 1. But when you go back in time like that, now you have the model up and running, right? It has to have some start point, and it has to have a little time to train. Now it's all been trained, it's ready to go. So you will have a period of time where for 9 months in this case, nothing happens, right? But going forward, the model's all trained, it's ready to go. It's all warmed up, right? So targets portfolio volatility. We saw the volatility, right? 12%. We try to minimize that volatility, maximize the gains, and that's going to maximize our Sharpe ratio. So that looks good. We rebalance only when needed using the triggers that were defined, right? Weight drift, volatility outside a tolerance around the target, and momentum regime flips. I'm going to change that formatting just a bit. I like this better. Okay, controls trading frequency, right? And we have the maximum 60% in one asset, minimum 0%. What else? The trades are frugal, right? So it's not trading high frequency or too much, and it's generating a lot of tax consequences or a lot of trading costs, right? We try to minimize that, and that improves our overall performance or overall gains. We account for all costs using basis points and any kind of slippage. Slippage is when the trade isn't executed exactly like you want. If you do any trading in your life, you'll see maybe the bid price is 100. You always look at the bid and ask, right? The bid price is 100. The ask is slightly higher, and the market maker is going to keep what's in between. But you might get just a slightly different not performance, slightly different like entry point for that trade. It might be off by a couple of basis points or a couple of pennies. That's slippage, right? And overall, the performance is reported in these charts that I just showed you, right? And I showcased all the trading activity over here. This is called the trade blotter. So you can see all the activities here, including the date, signal, buy or sell, price, delta, notional, which is the beginning, shares traded, and the cumulative unrealized P&L. So that's it, guys. That's everything in this smart portfolio rebalancer. Everything is done automatically. Just clicking in the cell, hitting Control Enter. You can set this up to run all in one cell. Just run it and you're done. I split the cells to make it a little bit easier to understand and to step through this a little bit. You know, when you're first doing this the first time, you don't want to have one giant script in one cell. If you have an error or bug in there, it's going to be harder to find. If you break it into different cells, it's just easier to troubleshoot, right? But at this point, everything's up and running. I'm pretty confident that the model is performing like it's supposed to. So if you wanted to, you can copy and paste everything into one cell. Like right here, just copy and paste all that code into one cell, delete everything above it, and you can run that if that's your preference. The last thing I'll say is this is an investment strategy. I can't say go ahead and follow this and you're going to make a ton of money. I don't want to mislead people. And by the way, don't try to sue me or whatever, because I have no money, so I can't even be sued. Like nothing would even happen anyways. But this is the stock market, right? You have to use good judgment. You have to be careful. You can get whiplash. You can get, it's called whipsawed, right? You buy high and sell low or something like that. The objective is to buy low and sell high, or sell high and buy low if you're doing shorts, right? But you can do the opposite and lose a lot of money very quickly, right? So there's no guarantees in the stock market, so just be careful. The strategy does work. It is profitable, but don't get angry with me if you don't make a ton of money using this strategy, right? That's not my fault. I don't control the market. I don't control these things. This is just an illustration of finance, financial engineering, what else? Mathematics, statistics, some computer science, a little bit of data science baked in there too, probably at some point. So that's it, guys. That's Smart Portfolio Rebalancer. That's it. I'm going to save this code. I'll share it with everybody so you have an example of the scripts here. And I'll load that when I load the video a little bit later today. So you can just copy and paste my code, run it in your own Jupyter environment, and you are good to go with that. If you have any questions, let me know in the comment section. If anything doesn't make sense, that's totally understandable. Some of this stuff is dense. It's complicated. I understand that. It took me years to master this stuff, years and years and years. And I'm still learning new things all the time. So my point is, if there's something you don't understand, Google it, chat GPT. If it's very, very specialized or specific question, why did I pick this strategy or why did I do this, then you can post that in the comment section. But if it's a general thing, I think you'll get a response much quicker if you Google it than if you put that in the comment section. But if you have any interesting comments, you like the material, you have ideas for similar but somewhat different types of analyses, and let me know in the comment section. Okay, hit the subscribe button. I'm going to drop this video pretty soon, and I'll share all the code with you when I post the video. Okay, that's it, guys. I'm going to wrap up here. Thanks for your time. Appreciate it, and I'll see you in the next one. Goodbye for now.